Hello. Welcome to our next chapter. So we are doing from our audit in 100 pages. So today we are doing audit of NBFC. Comparatively less important chapter, but NBFC in this attempt, that is your May 23 attempt, has some amendments. High probability they will ask you from this chapter. So this is approximately, sometimes they ask for 4 marks, sometimes 5 marks, sometimes nothing. So therefore this is approximately 1.92 marks average per attempt. In the last attempt it was asked for 5 marks, 0 marks, 4 marks. So make sure you still study it because there are amendments in this chapter. So now, first of all, your audit of NBFC. NBFC stands for your non-banking financial corporation. So now this is approximately 38 pages in your ICA study material that I have put in, maybe I think five pages. Yeah. Okay. So let's start with NBFC. That is, what is the definition of NBFC? So first of all, your NBFC, even though it is a non-banking financial company, it is still defined in your RBI Act. That is your Reserve Bank of India Act. Okay, so it is section 45 IF of the RBI Act 1997. It defines NBFC as first a financial institution which is a company. So first of all, it should be a financial institution which is a company, and second, a non-banking institution which is a company and principal business is receiving or lending of deposits. So it is a non-banking institution which is a company, and its main business is what? Receiving and lending of deposits. Great. So a company is an NBFC. When will a company be considered as an NBFC? Only and only when the financial assets, of the company are greater than 50% of the total assets. Okay. Now this is netted off by intangible assets. So when your financial assets are greater than 50% of total assets, and income from financial assets is greater than 50% of your gross income. So first of all, you have to check that your financial assets should be more than 50% of your total assets, and second, income from these financial assets should be more than 50% of your gross income. Now you have to remember, both these conditions have to be satisfied. It is an and condition. So it register as NBFC if both of them are satisfied. If both of these conditions are satisfied, then you have to register as an NBFC. Okay, the registration and regulation of NBFC. So under section 45 IA, please remember the section 45 IA, 45 IA, 45 IA, under section 45 IA. 45 IA of the RBI Act 1997, no NBFC to commence business without. That means before an NBFC starts business, he has to do two things. First of all, he has to obtain certificate of registration issued by the RBI. So the RBI issues your certificate of registration to whom? To NBFC. And second, so one is with regards to certification, second is with regards to net owned funds. So having net owned funds of 25 lakhs, so this was originally, but it has been 2 crores since April 1999. Okay, so income from financial assets 50%, financial assets itself 50%, then you are an NBFC. Okay, now NBFC, if you are, so what is the registration? First, you have to take certificate from RBI, and second condition is your net owned fund, that is 25 lakh, which has now been changed to 2 crores. Okay, so in the exam, if they ever ask you, you have to write both of these, because in the act it is still 25 lakhs, but they have changed it to 2 crores. Okay. Companies regulated by other regulators need not register with RBI. So companies regulated by other regulators need not register under RBI. That means if you are under one of these, you need not register. Okay, so I made a key for this. Of course, as for all chapters, I make keys. Okay, so this we've done. Company is your NBFC when financial assets 50%, income 50%. Then we did registration and regulation. We did two things. That is, first is obtain certificate, and second is your net owned fund. This is 25 lakhs and 2 crore. Okay, now next is companies regulated by other regulators need not register under RBI. So in this chapter, all our keys will be related to games. Okay, games and sports, all our keys will be related to that. So for this, it is my cricket squad is very healthy now. My cricket squad is very healthy now. It has 4 M's, 3 C's and 3 S. My cricket squad is very healthy now. Okay. So now what are these companies who need not register under RBI? Which companies are these? So your core investment company with asset size less than 100 crores. So if you are a core investment company and your assets are less than 100 crores, you need not register. However, if you are a core investment company with assets greater than 100 crores, with assets either equal to or greater than 100 crores, but you are not accessing public funds, then in such a case, you need not register. So either you are less than 100 crores, in that case, you can do anything except not accept, that is okay. But if if you're equal or over 100 crores, then you should not have access to public funds. Only and only then you need not register with the RBI. Okay, stock exchanges need not, housing finance institutions, your merchant banking companies, venture capital fund companies, securitization and reconstruction companies, companies engaged in the business of stock broking. So neither stock exchanges nor companies engaged in the business of stock broking. Your Nidhi companies, insurance companies, chit companies, microfinance companies, mortgage guarantee companies, and your mutual benefit companies. All of these companies need not register. All of these companies need not register. Okay. So that is your, I told you there are 4 M's. Okay. So microfinance, merchant, mortgage, and mutual benefit. These are your 4 M's. Then there is cricket. So there are your 3 C's. Core investment, and chit companies. Core investment, and chit companies. My cricket squad. Okay. With S, there are 3: securitization, stock exchange, and companies engaged in stock brokerage. Okay. My cricket squad is very healthy now. I is your insurance companies. V is your venture capital fund companies, housing finance institutions, and your Nidhi company. So my cricket squad is very healthy now. Okay. Now the next part that we'll be doing, there is an amendment in that part. So please make sure you hear it carefully. So first of all, you have to remember that your NBFC may either be deposit accepting or non-deposit accepting. All your all your NBFCs, each NBFCs can be divided into 2 categories. Either they accept deposits from the public or they do not accept. That is your deposit accepting NBFCs, and your non-depositing accepting NBFC. That is your NBA. Okay, so it will either be DA or it will be your NDA. Now NDA also, it will be bifurcated in 2 parts. Either it is systematically important or it is non-systematically important. So that is based on certain criteria. So either it will be DA, that is deposit accepting, or non-depositing accepting systematically important, or non-depositing accepting non-systematically important based on size. Okay, now this is your amendment. This table is your amendment. So those who have not purchased these notes, if you want, you can take a screenshot of this table. If you are using any other faculty's notes, if you are using older notes, so this is your amendment. Okay, and for those who really need these notes and you are watching this before exam, you can purchase it from the website and you will be granted access. Okay, now your layers of NBFC. So there are basically 4 types of layers. One is your base layer. Second is your middle layer. Third is your upper layer, and fourth is your top layer. So basically, they have divided NBFCs into 4 layers. That is based on risk, assets, etc., etc. So they've changed it into 4 layers. Okay, so in your base layer, which all NBFCs come? NBFC non-deposit accepting. Okay, so NBFC non-deposit accepting, whose assets are less than 1,000 crores. NBFC non-deposit assets less than 1,000 crores. NBFC is undertaking the following activities. So if the NBFC does these activities, it will come under the base layer. Okay. So first is your peer-to-peer lending platform, account aggregator, non-operating financial holding company, non-availing public funds, and no customer interface. And last is your government-owned NBFC. So now your government-owned NBFC, it can either come in base layer or it can come in middle layer. Okay, so therefore it is said BL and ML. So wherever in the bracket I've put this ML, BL, etc., etc., that means this can either come in base layer or it can also come in your middle layer. Okay, so in NBFC base layer there are basically 2. First is your NBFC non-deposit accepting. Okay, so NBFC non-deposit and assets are less than 1,000 crores, and second is specified businesses. Okay, so we did the specified businesses also. Then second is your middle layer, that is your NBFC ML. So NBFC middle layer is NBFC non-deposit. Okay, over here also NBFC non-deposit, but over here if you see assets were less than 1,000 crore, over here it is assets equal to or greater than 1,000 crores. Second, NBFCs deposit accepting, that is they take deposits. Asset size does not matter. If you are accepting deposits, no asset size matter. You will straight away come in the middle layer. However, you will either come in the middle layer or upper layer. Okay, so you will either come in the middle layer or the next layer, that is your upper layer. Okay, and NBFC is undertaking following activities. So some more activities have been specified. Your standalone primary dealers, infra debt fund, core investment companies, housing finance companies, and your infrastructure finance companies. So if your NBFC is undertaking following these activities, it will come under the middle layer. However, for your core investment company and for your housing company, for which companies? For your core investment company and your housing finance company. Core investment company and housing finance company. Core investment company, that is your CIC, and there is your housing finance company, that is your HFC. So CIC or HFC or your infrastructure finance company. So basically your last three. So your core investment company, your KIC, your HFC or your IFC, your KIC, HFC, IFC, KIC, HFC, IFC, KIC, HFC, IFC, KIC, HFC, IFC. These three will either come in the middle layer or they will come in the upper layer. Middle layer, upper layer, middle layer, upper layer. Which? KIC, HFC, IFC, KIC, HFC, IFC. These will either come in your middle layer or they will come in the upper layer. Rest will always come in the middle layer, and your deposit accepting is also coming in middle layer and upper layer. Okay. Which ones? KIC, HFC, IFC, KIC, HFC, IFC. Okay. Next is your upper layer. So top 10 eligible NBFCs in terms of asset size. Top 10 will come in this layer. Apart from addition, and these all will come additionally. That means which we specified over here separately. These will come, and over here top 10 eligible NBFCs will also come. Okay, next is your top layer NBFC, top layer NBFC TL. Okay, so NBFC TL. RBI may move NBFC from your upper layer to top layer if higher systematic risk. So if they feel there is higher systematic risk, as I told you, these layers are made on basis of risk. So any NBFC may be moved from upper layer to top layer if the RBI feel that there is greater systematic risk. Okay, so it will be moved from upper layer to top layer. Okay. NBFC investment and credit company, microfinance institution, factors, and mortgage guarantee company can be in any layer. Your NBFC investment and credit company, your microfinance institution, factors, and mortgage guarantee company, they can come in any layer. Okay. Next is the difference between banks and NBFC. So you will ask me, sir, what is the difference between banks and NBFC? So here it is. Okay. This comes for this can come in the paper. So make sure. So first of all, your deposit insurance facility of DICGC is not available to depositors of NBFC. So that means this facility is only available to banks. Next, NBFC do not form part of the payment and settlement system and cannot issue checks drawn on itself. That means NBFC cannot issue checks, which banks can. NBFC cannot accept demand deposits. However, some NBFCs can accept term deposit. That means these deposits will not be repayable on demand, but they will be repayable when the term ends. So therefore, NBFCs, when we say public deposit accepting, these are when the term ends, you will be paying. So therefore, it cannot accept demand deposits. Only your bank can accept your demand deposits. And next, no minimum exposure to priority sector required by NBFC. So your RBI will specify certain sectors where banks have to lend money. That means they have to have an exposure over there. Why? To boost that particular sector. Now this will not be applicable to NBFC. Therefore, no minimum exposure to priority sectors required by NBFC. Okay. So we'll see the keys that we've made. Layers of NBFC. I told you 4 layers of NBFC. That is your empire may be tensed. UMBT. Now this is of course not in the same order, but this is your base layer, middle layer, upper layer, and top layer. Okay. Next, difference between banks and NBFC. So that is your my player dislikes dodgeball, MPDD. So there is a minimum exposure priority sector, not there. Payment and settle system, not there. Deposit insurance facility, not there. Demand deposits, NBFC not allowed. Okay. So that is your MPDD, my player dislikes dodgeball. Okay. Now next we are coming to your prudential norms. Next is your prudential norms. Okay. So now your prudential norm, basically there are 3 types of prudential norms. First is with regards to provisioning. Second is with regards to your capital requirement, and third is with regards to income recognition. These are your three prudential norms. Okay, so first let's see provisioning. That means I hope everybody knows what provisioning is. When you lend someone money and they do not repay you back, you'll have to make a provision that boss, maybe I will not receive this money. So the prudential norms, they have already specified that boss when to classify which asset as what and how much percentage of the amount due you have to make as provision. So every NBFC except NBFC MFI to make provision against substandard, doubtful and loss asset. Substandard, doubtful and loss asset. Substandard, doubtful and loss asset. So your loss asset shall require 100% provisioning. Your substandard asset requires 10% provisioning. Your standard asset will depend on what you are. Okay, so loss asset is 100%, substandard asset is 10% provisioning. But your standard asset means something, there is no wrong with that asset, but you will still be making a provision. So standard asset will depend on what you are. So if you are a systematically important non-deposit taking, or you are systematically important if you are systematically important deposit taking, so that means what it means, that if you are systematically important, doesn't matter whether deposit taking or non-deposit taking, you have to make a provision for 0.4%. 0.4% if you are systematically important for your standard assets. However, if you are non-systematically important and non-deposit taking, in such a case your provision will be 0.25%. Non-systematically important and your non-deposit taking. Okay. Provision towards standard asset need not be netted from advances. It has to be shown separately in contingent provisions against standard asset. That means if you have a standard asset, say for rupees 100, and you made a provision for say for rupees 4. So that means you do not have to show the standard asset as 100 minus 4. You do not have to show it at 96. You have to show standard asset at 100 and separately you have to show this 0.4% as a provision that you are making under contingent provisions against standard asset. Okay, now doubtful asset. Basically, what is your doubtful asset? So your doubtful asset, if part of advance not covered by realizable value of security. For example, you lent a loan for 100 rupees and the person gave you collateral. Now that collateral is worth only 80 rupees, so now 20 rupees. This 20 rupees is not covered by the realizable value of the security. So for this 20 rupees, you have to make 100% of the provision. Okay, so that is the value that is not covered, that requires 100% provision. Period for which it is doubtful. If it is up to 1 year, 20%, 1 to 3 years is 30%, and more than 3 years is 50%. So 20, 30, 50, 20, 30, 50, 20, 30, 50. 1, 3, more than 3. 1, 3, more than 3. 1, 3, more than 3. 20, 30, 50. 1, 3, more than 3. 20, 30, 50. Okay, so 20 plus 30 is your 50 if that's how you want to remember. Great. So this was with regards to your provisioning requirements. Now next is with regards to your capital requirements. So every applicable NBFC as defined in the master direction NBFC systematically important non-deposit taking and deposit taking company. So it has been defined in the master direction NBFC systematically important non-deposit taking and deposit taking company directions 2016 to maintain capital ratio. So some capital ratio they have defined. That is, I am pretty sure you have heard tier 1 and tier 2 capital. This you would have done in your inter also, you won't remember. Okay. So that is greater than 15% of its aggregate risk weighted assets. So different type of assets are given different risk. So this should be greater than 15%. NBFC is engaged in lending against gold jewelry. Such loans greater than 50% of their financial assets. That means if they are lending against gold jewelry, and these loans are more than 50% of their financial assets, if these particular loans are more than 50% of their financial assets, then in such a case they shall maintain a minimum tier 1 capital of 12%. So instead of 15%, it is 12% for tier 1 capital. Okay. So now your asset class. So basically there are your 4 types of asset classes, and I have given weights over here, that which type of asset class has how much weight. Okay, cash and bank. It includes your fixed deposits and any certificates. Its weightage is 0% because there is no risk in this. Okay. Next is your investments. So investments in approved securities, of course, these will be riskless, therefore it is 0%. If it is bonds of public sector banks, it is 20%. All assets covering PPP and post commercial operations date, that is your COD, infrastructure projects in existence over a year of commercial operation, this will be your 50%. All assets covering PPP and post commercial operations date, okay, infrastructure project, this is your 50%. Okay, so you don't have to remember these words. This they will be giving you. This sentence they will be giving you. What you have to remember is you have to remember the percentage that was over here. I read it as 50%. Okay, so your public sector bonds of public sector banks is 20%. If this is it is your 50%. Okay, next your current assets. Current assets, loans and advances fully secured. Loans and advances fully secured against deposits held is 0, and loans to staff is also 0. These are your current assets. Risk weightage is 0. Next is sovereign. Fund-based claims on the central government, 0. Direct loan, credit, overdraft exposure, and investment in your state government securities. If there is any investment in your state government securities, that is also 0. If there are any central government guaranteed claims, what you have to remember is it is CG. SG guaranteed is not there, it is only CG. Okay, so over here it is 0% because state government guaranteed claims which have not remained in default, which are in default for a period of not more than 90 days. So either they have not in default or they are in default for less than 90 days. In such a case, equal to, sorry, not less than 90 days, equal to or less than 90 days, in such a case, there will be risk weightage of 20%. So if it is backed by central government, 0%. If it is backed by state government and there is no default, then it is 20%. If there is default, but default is less than or equal to 90 days, then it is your risk weightage is 20%. Anything you see other than these, your risk weightage shall be 100%. Okay, anything you see apart from these that I mentioned in the table, risk weightage will be 100%. So if during the exam if you come across the statement which you do not remember reading over here, please give a risk weightage of 100%. However, if the statement is from here, please remember these. Please remember these. I will erase these for so that you can read these, and if you want to take a screenshot while you're watching the video. Okay, so this was your capital requirements. Okay, now coming to your next is your income recognition. Income on NPA recognized only when realized. NPA is your non-performing asset. So any income you will recognize only and only when you actually receive it. That means not on accrual basis but on receipt basis. Asset classification is as follows. So as we did standard asset, substandard asset, NPA. So when will an asset become what? So that depends on what you are. If you are a non-systematically important, non-deposit taking NBFC, non-systematically important, non-depositing, or if you are systematically important, either non-deposit or deposit taking does not matter. However, if you are systematically important, then it is this one. If you are non-systematically important and non-deposit taking, then it will be this one. Okay, now your standard asset, no default in principal or interest. There has been no default, everything is going proper. Whenever the due date is, that asset is we are receiving the income, there is no issue. In such a case, standard asset is easy. Okay, now talking about NPA. NPA, if the interest or principal bill is overdue for equal to or greater than 6 months or 3 months, in such a case it will become an NPA. So either the interest, principal or bill is overdue for a period equal to or greater than 6 months. So if it is greater than 6 months and you are NSI ND, that is non-systematically important, non-deposit taking, then in such a case it will be treated as an NPA. Okay, so for them it is 6 months, for these it is 3 months. Next, this done. Next, lease rental, hire purchase installment overdue for equal to or greater than 12 months and 3 months. So what you will notice that your systematically important NBFC, the time period is low. That means even if there is little default, even if there is a default for very little time, we will still be considering it, we will still be putting it as a classification. Okay, so if you see, it will always be less. 3 months, 6 months, 3 months, 12 months, 12 months, 18 months, 12 months, 18 months. Okay, so this is how you remember. Next is your substandard assets. Asset which has been classified as an NPA, what you have to remember, this is not over here, it is not from date of default. It is from date when it is classified as NPA. So first your asset will be classified as NPA. From that date now you are calculating. So asset which has been classified as NPA for not exceeding 18 months and 12 months. Okay. Asset where terms with respect to interest principal have been restructured. That means it has been changed from the original schedule until expiry of 1 year of satisfactory performance under restructured terms. Okay. So till the period of 1 year till you have restructured, it will still be considered as a substandard asset. Okay. Now next is your doubtful asset. Asset which has been classified as substandard. Okay. Remember NPA we did from it is overdue. NPA we calculated from date overdue. Substandard we calculated from the date it has been NPA. Now doubtful asset we are calculating from the date it has been substandard. So I hope you are getting it is layer by layer. We are calculating from that date from when it has gone into that class. So asset which has been classified as substandard for not exceeding over here also it is 18 and 12 months. Over here also it was 18 and 12 months. It is the same. And loss asset is your asset identified as loss asset by your internal external auditor or the bank themselves. So if they have identified it to be a loss asset, it will be treated to be a loss asset. Okay. I hope this is clear to you. 6 months, 3 months, 12 months, 3 months, 18, 12, 18, 12, 6, 3, 12, 3, 6, 3, 12, 3, 18, 12, 18, 12, 6, 3, 12, 3, 18, 12, 18, 12. Okay. Now next is what are the audit procedures. So your audit procedures will be, of course, you have to ascertain the business of the company, study the memorandum of association and your AOA, your MOA and AOA business policy minutes of board meeting. Evaluate the internal control system that will help you identify the nature, timing and extent of audit procedures. Next is registration with RBI, that is whether you have received it under 45 IA and whether investments in prescribed liquid returns have been filed, and that is your quarterly filing. Next is your NBFC acceptance of public deposit directions. Okay. So NBFC acceptance of public deposit directions. So I have made a key for your these points also A, B, C, D, E, F, G. All of this I have made the key. Okay. So check whether they have complied with these conditions. Check whether public deposits accepted are within the credit rating, within the limit of the credit rating. If in case of downgrade, if in case of downgrade of rating below the threshold limit, what do they have to do? They first have to stop accepting fresh deposits, all existing deposits to be run off till maturity. You cannot do it midway. Okay, you have to wait till maturity. And last is report position within 15 working days to the concerned registered office of RBI where the NBFC is registered. Wherever the NBFC is registered, that registered office of RBI, you have to report position every 15 days. Okay, so why this situation might happen? For example, if according to your rating, according to a rating, you are allowed 100 crores. But so you took 100 crores, you took 100 crores worth of deposits. Now your rating fell down, and as per the new rating, you are only allowed 80 crores. So you are automatically 20 crores above the limit, correct? So therefore, this situation is covered over here. Next is test check the interest calculation in respect of public deposits brokerage commission. Whether NBFC has accepted public deposits only after a written application from the depositor. Verify, verify the deposit register maintained. Whether investments made in liquid assets have been lodged in safe custody of the commercial bank. That means liquid assets shall be put in safe custody of the commercial bank. Whether NBFC has filed its prescribed returns in a timely manner. All the returns have to be filed. If NBFC non-deposit taking, check whether a board resolution has been passed stating that it has not accepted any public deposits. So therefore, there should be a board resolution stating that we will not be accepting any public deposits. Okay, next is your NBFC prudential norm. So NBFC prudential norm is check compliance with prudential norms with respect to income recognition, income accounting, investment, asset classification. Okay, so this is a long list that you have to check. Next, ensure that your BOD granting loans shall frame and implement a policy for the company. Verify that advances have been properly classified as your standard, substandard, doubtful and loss, SSDL. Standard, substandard, doubtful, loss. Standard, substandard, doubtful, loss. Standard, substandard, doubtful, loss. Standard, substandard, doubtful, loss. NPA unrealized income not been taken to the P&L account on an accrual basis, because what did we study? Your NPA's income has to be taken to PL only and only on receipt basis, not on accrual basis. Next, examine accounts which are NPA last year but not this year. So you have to check whether there is any window dressing or not. How was an asset that was NPA last year but this year it has been corrected? So check whether the payments are genuine or not. Okay. Now next is your classification of frauds by your NBFC. So the key is Football Club Munia. Okay, FC Munia. First is your fraudulent encashment through forged instruments, manipulation of books of accounts. Then there is cheating and forgery. This is your FC. Now there is Munia. M is your misappropriation and criminal breach of trust. Misappropriation and criminal breach of trust. With F we did fraudulent encashment. With C we did cheating and forgery. With M we did misappropriation and criminal breach of trust. Misappropriation and criminal breach of trust. U, unauthorized credit facilities extended for reward or for illegal gratification. N, negligence and cash shortages. Okay, so this has an asterisk over here, so we will be studying this box. I, irregularities in foreign exchange transactions. Irregularity in foreign exchange transactions. N was your negligence and cash shortage. N was your negligence and cash shortage. F was your fraudulent encashment through forged instruments. Fraudulent encashment through forged instruments. I is your irregularities in cash in foreign exchange transactions. Irregularities in foreign exchange transactions. And next is any other type of fraud. Okay, so it is FC Munia. FC Munia, classification of frauds. Okay, so classification of fraud is first is fraudulent, cheating, misappropriation, unauthorized negligence, irregularity, and others. So, okay, any others. Okay, now these two asterisks we did, it will be reported as fraud. It will be reported as fraud. Why? Because we did any cash shortage and we did any irregularities. So, what do you mean by cash shortage? How much? So it will be reported as fraud if cash shortage is more than rupees 10,000. Rupees 5,000 if detected by management or auditor and not reported by person handling cash. That means if the person who is handling cash, if he did not report, then in such a case, instead of 10,000, the limit will fall to 5,000. That means because if that person has not reported it, which means there is something fishy in it. So if someone else reports it, it will only be, your limit is only 5,000. Okay. Now next is your audit checklist. Audit checklist. Physically verify all shares in securities held. Verify whether NBFC has not advanced any loans against security on its own shares. Okay, so against own shares you cannot lend. Test check prices in bills received from brokers vis-a-vis the stock market quotation. So that is what the broker has charged you versus what the quotation in the market was going. Verify the board minutes for purchase and sale of investments. Verify board minutes. Okay. Check whether investments have been valued as per the NBFC prudential norms and whether provisioning has been done for the security. Verify that the investments made in subsidiary or group companies during the year. Verify those investments. Investments in unquoted debentures to be treated as long-term loan and not an investment. So if you have made an investment in an unquoted debenture, now why do they say this? Unquoted debenture means it is not actively traded. It is basically you have actually given a loan. You cannot come out of this anytime. So therefore, when you have made an investment in unquoted debenture, that means debentures which are not listed, that are not traded actively, in such a case it will not be treated as an investment, but it will be treated as a term loan, because you will get it as a specified time when this debenture matures. Ascertain whether the requirements of your AS13 is accounting for investments have been complied. Obtain a confirmation from the depository regarding securities held by it on behalf of the NBFC. So if any depository has NBFC securities, so you will obtain confirmation from them. Verify changes received or paid in respect of securities lent or borrowed. Verify that the NBFC has not lent or invested, so neither given in any form, either in case of borrowing or investment, greater than specified limits to any single or group of borrowers. So there are certain specified limits as to how much you can give to one single person or group of borrowers. It has to be remain within that limit. Next, verify that proper documents have been maintained for every bill discounted or rediscounted. I hope you know these bills discounted is your bills of exchange that you discount. Obtain balance confirmations from the concerned parties, and last is check classifications of loans and advances. You know classification into standard, substandard, doubtful, and loss. So that classification you have to check. Now this is an illustrative and not an exhaustive list. That means there can be more items in this audit checklist. I have written the ones that I found in the ICI module. Okay. Now coming to your last page. Is this your last page? Yes. Coming to your last page, that is your auditor's duty. So auditor duty is to compliance with NBFC auditors report RBI direction. So whatever the RBI gives direction, auditor has to comply with those. Auditor of NBFC to which accepts public deposits should inquire whether statement relating to deposits have been furnished to RBI or not. So if your NBFC accepts public deposits, you have to inquire whether whether the statements have been furnished to RBI or not. Now next, material to be included in auditor's report or statement. So in case of all NBFC, three things have to be added. That is whether certificate of registration is there or not. If they have the certificate of registration, whether they are eligible to continue to hold the certificate of registration. And third is whether meeting the requirements of your net owned fund. So I hope you remember your net owned fund requirement. That is originally it was 25 lakhs, which is now 2 crores. So that is your net owned funds limit. So that is in case of all NBFC. Now second is in case of NBFC non-deposit taking. NBFC non-deposit taking. Whether the board of directors has passed a resolution for non-acceptance of any public deposits. This we studied earlier also. Whether the company has accepted any public deposits during the relevant period year. If they are non-deposit taking, how can they accept any public deposits? Okay, so therefore this also has to be mentioned. Whether the company has complied with the prudential norm that we studied above. Okay, and next, fourth is your whether it has been correctly classified as your NBFC microfinance institution. So if it is a microfinance institution, whether it has been correctly classified. In case of NBFC deposit taking. So whether public deposits accepted plus other borrowings are within the limit, it should be within the limit. Whether public deposits held in excess of quantum of such deposits permissible are regularized. So if you remember, like you regularize your attendance, so therefore they are also given a period to correct this difference. Whether it is accepting public deposits without minimum investment grade credit rating. You, as I told you, there is a minimum investment grade credit rating that will depend, that will check how much deposit they can accept. So they should have a minimum investment grade credit rating. Whether the capital adequacy ratio, how much was it? It was 15% and 12% if it was accepting through gold. So whether the capital adequacy ratio as disclosed in the return submitted has been correctly determined and is in compliance with the minimum CRAR. Okay. Whether it has defaulted in paying to its depositors, and next is whether it has violated any restrictions on acceptance of public deposits. So if there were any restrictions placed, if it has violated any of those restrictions. Reasons to be stated for unfavorable or qualified statements by the auditor. Of course, you cannot just give an opinion, you also have to give as to why you are giving this opinion. Obligation of audit to submit exception report to concerned regional office of RBI if any statement in the boxes above is unfavorable or in the opinion of the company, auditor has not complied with either. So, three things. First is your provision of Chapter 3B of RBI Act, NBFC acceptance of public deposit directions 2016, and last is your NBFC non-systematically important non-deposit taking company directions 2016 and NBFC systematically important non-deposit taking and deposit taking company directions 2016. I know this is a long statement. So basically your NSI NDT and your SI. SI can be any NDT or DT. Okay, non-deposit taking or deposit taking company. And next is your compliance with your CARO 2020. So we have already done CARO 2020. So I hope these clauses you will remember. If you don't, quick, it is a small video of 10 to 15 minutes. Watch this. So it has to compliance with two clauses, that is your clause 3 and clause 16. Clause 3 and clause 16. And under clause 3, it is B, C, D, F. And over here, it is your first four, that is your A, B, C, D. Okay, numbering and everything is same. You can find the video on in the playlist section only. Okay. So this I've given in CARO, therefore I've not given very much in detail. And coming to your last part of the chapter, I've made the mnemonics for the entire chapter. Okay, so you will find this on Telegram, the mnemonics for everything that we are done. Okay, now next is your Indian Accounting Standard, which you also call as IND AS. Okay, so that is your Indian Accounting Standard. So all listed and unlisted NBFCs plus your holding subsidiary JV associate with net worth either equal to or greater than 250 crores are required to comply with NDS. What did I say? All listed or unlisted NBFC, listed or unlisted NBFCs with net worth greater than or equal to 250 crores, they have to follow your NDS. Now the difference between the NBFC that follow NDS versus other people who are non-NBFC but follow NDS. So that is your division 3 versus your division 2. Division 3 is your NDS for NBFCs and this is your NDS for other than NBFC. That means all other people who follow NDS but they are not NBFCs. So your NBFC is allowed to present the items of balance sheet in order of their liquidity. That is how liquid an asset is or how liquid a liability is. On that basis, you can arrange. However, for others, this is not there. No, others don't have this option. Next, disclose by way of note any item of other income or other expenditure which is more than 1% of total income. This you can show by note if it is more than 1% of your total income. However, for others, it is 1% of revenue from operations or 10 lakhs, whichever is higher. 1% or 10 lakhs, whichever is higher. 1%, 10 lakhs, whichever is higher. 110, whichever is higher. 110, whichever is higher. This is for others. Next, disclose under receivables the debts due from any LLP. Debts due from any LLP in which its director is a partner or member. That means director of NBFC. Director of NBFC is either a partner or a member of the LLP and this LLP has borrowed money from the NBFC, then this has to be disclosed. So disclose under receivables debts due from any LLP in which its director, that is NBFC director, is a partner or member. Over here, there is no such requirement. Next, disclose items comprising from revenue from operations and OCI on the face of the statement of P&L. Over here, it has to be shown in notes. So over here, it has to be shown in notes and over here, it has to be shown on the P&L. And last part of this chapter, separate disclosure of trade receivables which have significant increase in credit risk and credit impair. So there should be separate disclosure given for any trade receivables which have whose credit has been impaired. That means you do not think that you will get this money back, or there is increase in credit risk. There is a significant increase, and for other there is no such requirement. And with this, okay, so these keys I have made. I'll just show you an example. For example, we did this audit checklist. We did these big parts, and in the end, it was written that this is an illustrative list. So, sports upsets cheerful people, but it is life. So, this also I've given sports upsets cheerful people, but it's life. Okay, and this is just your 13. So, I made all of these keys. All of these keys will help you remember. We did these differences. Okay, so all of this you will find on all of this you will find on the Telegram channel. Don't worry, and I will see you in the next video. And with this, we are done with this chapter.